Investors Chronicle.
Welcome to the Investors Chronicle Companies and Markets show. It's Thursday, the 15th of August as we record. Some of the heat has come out of big tech valuations this summer, and for one company in particular, things have just got trickier still. 10 days ago, the US Department of Justice won a major antitrust case against Google, the presiding judge labeling the company a monopolist. With artificial intelligence also a threat to Google's search monopoly, our cover story this week examines the prospects for parent company Alphabet. Arthur Sants will be on the show later on to discuss. Today we are also taking a close look at financials. Financials, that's to say what we've learned from the latest set of results from around the financial services industry. We begin the show in a moment with Julian Hofmann on UK life insurer Just Group, one of the biggest risers of the week. And we'll finish with Jemma Slingo on One Savings Bank, one of the biggest fallers of the week. In between Julian and Mark Robinson, we'll also be examining well-received figures from Aviva, and we will touch briefly on Admiral as well. Julian, welcome to the show. Let's talk about Just Group to begin with, something positive, because the results were very well received. Once again, the momentum really seems to be continuing. What did you make of the figures?
Yes, it's a very good one. Obviously, Just, formerly known as Just Retirement. The figures were excellent, actually, on their own terms, because Just has bet big over the last couple of years on the bulk annuity market, which is where pension funds that have reached maturity in some way or are in surplus decide to move their liabilities over to the life insurance industry, and sort of Just has positioned itself in the sub £1 billion segment of the market, so it's got about a fifth of that market in terms of market share. And the figures were really good. I mean, operating profits were 47% ahead year on year, and well above consensus forecasts. And all of that is down to the business they're writing with various pension funds in terms of transferring the assets over to them. And they've been quite good in terms of keeping their pricing and everything disciplined. But they're actually working to a margin of about 9%. It's the highest in quite a long time. So every new contract they write is generating about 9% profit margin. So it's a very positive set of results for them. And I mean, we've been positive on them for quite a long time. But it's come to the stage where the market has caught up with what they were doing in terms of positioning themselves to take advantage of the bulk annuity trend.
Yeah,
and it's a very. I think generally speaking, it's been well run. They're not taking on unprofitable new business, so not straining their balance sheet too much. Yes, so it was. The market rewarded the results, and it's been on some momentum since the fall years. But people are starting to see that they're actually producing the profit that their business model should be producing.
It does seem, the market has taken a long time to notice this, though, doesn't it? I mean, as you've mentioned, we've been positive on them for a while. I know, Julian, you've also been positive on XPS Pensions, which is tapped in a slightly different way, more of a consultancy way to the same kind of market, and has seen similar, if not quite so spectacular, share price growth over the past year, 18 months, but still in excess of 50%. And it does seem with just that every result that comes out, the market thinks, oh, this business is booming. We hadn't really realised it would continue to boom. I don't know.
No, I mean, it didn't go anywhere for a long time. I was teasing our colleague Alex Newman that we would call this the Alex Newman Memorial tip at some point, because we've been positive on it for so long, but it wasn't going anywhere.
Yeah.
But it is really about the market background, but it's not just that. It's the fact that they're doing quite clever business, really, with their resources. I mean, this isn't a Legal and General or Aviva who can chuck billions of capital at very large pension funds. They have to pick and choose. But they're doing it in quite a clever way, really.
I'm going to blow our own trumpet a little bit more, though, because I do think, notwithstanding Alex's old tip, I think it was, when was it, last autumn, something like that, we did highlight Just, and they were added to Bear Bull's portfolio this year too. And to me, it does seem ever since interest rates went up materially, even since the mini budget, really, that knock-on effect of that was to put a lot of the schemes into surplus for the first time, which gives them the opportunity to do a deal with an insurance company like Just, and you've seen a lot more of these deals happen as a result. I suppose the flip side of that is base rates are starting to come down a little bit. They're not going to fall all the way back to where they were, but what's the outlook look like? What does Just think the outlook looks like in general, but also in the context of a market where gilt yields are starting to fall back? What would that imply for the amount of business they can be able to do in future?
Well, I mean, for their own purposes, they look at the whole market itself, and they still think there's about £25 billion worth of business that they can bid for, which gives them a runway of 2 to 3 years in terms of potential transfers. So you're looking at stability of earnings for at least 2, maybe perhaps 3 years before that those interest rate changes start to kick in materially, as it were. So I think it's enough runtime for the share price to catch up with what is the intrinsic value of the company. So the shares are still only valued at about a third of the book value of the company, which is very cheap for a life insurance company. They're usually up at about 1.5 times, and you can see that there's a long window for the shares to keep running up for a while. So I wouldn't worry for another maybe if we're having this conversation in 2 years' time, it might be a slightly different one. We might be talking more about consolidation, but at the moment, it's still a great story.
I think the chief exec did note as well that a lot of pension schemes, wisely and unsurprisingly, have locked in the effectively the high yield position to enable them to continue to shift these liabilities when they wish, even if gilt yields do fall down. So that helps as well. There was though an interesting note from RBC the other month, I think it was June, talking about potential though for a bit of a shift in the industry, the DB pension industry, with regard to the number of schemes who might consider re-risking their assets, running them on for surplus rather than looking to offload them in future, with the UK proposals in mind about some changes to surplus rules, things like that. I mean, RBC did downgrade L&G partly on the back of this analysis, but they seem to think, and maybe it's fair to say you might do as well, Julian, that Just is a bit more protected from this because it fishes in the, as you said earlier, the smaller end of the market. So maybe where these trends are going to be persistent for a while longer. Yeah,
exactly. I mean, we're not talking mega schemes here. I mean, this is like these are maturing at the moment, defined benefit schemes at the smaller end of the scale. And they also talk about the fact that they're going to start moving into defined contribution schemes as well. That's the next round of growth opportunities. So it's they're in a sweet spot, really. They don't have to keep the range of shareholders happy like L&G does, really. And the minute that their dividend doesn't grow, the minute their dividend grows marginally less than everyone expects, it's a massive disaster. But I don't think people are putting that kind of pressure on Just.
Yeah, Mark, let's bring you in here. What are your thoughts on Just Group?
Well, just in terms of the DB issue there, it was interesting because I found some recent research from XPS, and they were saying that there's no single reason why transfer activity in terms of volumes wouldn't necessarily have to fall in the near term, or they did point out that lower transfer volumes often coincide with falling transfer values. But my general point is that there's bound to be a natural tapering at some point simply due to attrition. It's unavoidable in a sense. In terms of the valuation as well, I think Julian pointed to recent research from Peel Hunt that said the company was trading at a sizable discount to its intrinsic value, but that also counts in terms of reported net asset value too. And when you combine this, they've got a solvency ratio which is approaching 200%. It's unsurprising that the market still sees some value there.
Yeah, makes sense. Well, let's turn to another insurer where a lot of people are seeing value at the moment, albeit the market reaction to their results was much more muted, it's fair to say. That's Aviva. Julian, a much wider scope of business at Aviva, much more similar to L&G, who we've just been talking about a bit. But the results themselves, first of all, what did you make of the results?
Yes, Aviva did not set the world alight, I would say, not with these particular set of results. It was all in line. It was perfectly acceptable. The business looks a lot more focused and profitable, really, on what they've concentrated on. So it was the UK general insurance business, which comprises, all bits of motor, health, and also markets like Ireland and Canada as well. It all comes back together, and that grew noticeably well. They wrote more. They brought in about 18% more in terms of premiums, which is well ahead of the group, which is about 10 or 12%, and certainly at the top end of what the major insurers are doing at the moment. So it was perfectly good. But everyone at these days looks at Aviva and says, well, are they going to do another big payout of some kind? And there wasn't any indication in these results that they're going to do any more share buybacks than they've already announced. So the market wasn't particularly excited about it, but it on its own terms, the company's doing well. And now that they've sold off all these foreign businesses and still have a lot of cash in the bank, they're not going to suffer at all, I don't think. But there isn't enough. The share price is really responding to buybacks at the moment for them, and there weren't any in these results.
Yeah, they have had a good run, the shares, this year and over the last year as well. Not as much as the pure play bulk annuity players we've just described, but up, I think, about 30% over the past year. So those buybacks have had some effect. What about the UK general line? I mean, UK business seemed to do pretty well. I think there were some comments in the press from management saying there's still, unfortunately for most of us, still some way to go in terms of price appreciation for home insurance, things like that.
They did that. They sort of told everyone with a certain amount of glee, I think, that they're expecting something between 8 and 10% hikes in premiums this year or the year coming. And that might run for another year after that. But it's a hard insurance market at the moment. So everyone across the line is making money hand over fist from rising or hard rates. And so it's that, in a sense, comes as no surprise. They should really be doing that. And we didn't really attract much comment. So I think the market has kind of baked that into the price already.
Yeah, I think it's a sign of what's been going on. The premiums are up 15% in the general insurance business year on year, which certainly is reflected in the some of the quotes that people will have been seeing for their own insurance, I'm sure, if not greater than that. Looking at other segments of the business, I mean, it has slimmed down, as you say. It's sold off a lot of overseas assets, quite focused on the UK and Canada now. Other areas which are looking particularly strong at the moment. It's got the asset management arm as well, which helps fund the main business, of course. What do you think?
Yeah, I mean, asset management doesn't play much of a role for them. The one thing that I thought was quite interesting, and it sort of confirmed a trend we've been seeing, is that their health insurance business is really starting to pick up. Aviva does have a small, admittedly small in terms of the overall group interest in health insurance. And it appears to be seeing a substantial take-up of this because in the UK particularly, there are issues in the broader NHS that are causing people to turn to private provision of one sort or another if you can afford it. And in the results, there was something like 30% growth in their health insurance business. So that I thought that was quite notable. The Canada business was also pretty solid. I think they were up around 10% for the year. But it's much easier to understand what Aviva's about these days, despite the fact that they tend to sprawl across different markets. They seem to be doing better individually now that they aren't having to concentrate on what's happening in Asia or all of those kind of insurance businesses they sold off in the last couple of years. And I think that's a positive sign overall for investors. Most of whom will be in this stock because the dividend payout is really solid. And you're looking at nearly 7% yield even at the moment. So it's a vital and important income share for a lot of investors.
Yeah, would you still see the valuation as being relatively attractive, not least on that basis, given the yield it still offers?
It's valued around 12. So it's a rough premium to say LNG or M&G, but I think because it's a broader business, it has less. It carries probably less risk. So you could be happy to pay that for getting 7%. I think.
Yeah, I think the figures as well, things I've seen, they do suggest there'll be a decent level of dividend growth coming through as well. So that yield, as far as we can make out, is not only decent, but potential to grow quite significantly too. Let's touch on Admiral, which reported today. Figures well received by the market again. Focus much more on motor insurance, of course. What did you glean from those results?
Well, Admiral really smashed it. I mean, they're up like 8% this morning in the market, but they are benefiting really from their hugely dominant position in motor insurance. So they made an interesting decision at the start of the year to discount slightly when it came to their rates. But the importance of that is that they attracted a huge number of new customers. So they had something like 15% customer growth just in the UK motor insurance division, which is obviously their biggest. And that has helped to deliver this record number of this record increase in operating profit, which is something like 43% when I looked at it. And basically, so it's a textbook example of how you build profitability through pricing and volume. I mean, they've kept the pricing at just the right level, and the volume has come their way.
Yeah,
and because of their dominance in the market, that's essentially generated operational gearing, and everyone noticed that pretty quickly, I think. And I mean, it also helped that they started paying out quite a big special dividend in this, something like 60 million just in special dividend, and they're paying out over 90% of the earnings in dividends for the half. So yes, people are quite excited about what they're doing, but you're going to pay a lot more for Admiral than you are for, say, Aviva. I mean, Admiral's well over 20 in terms of valuation.
Mark, a final word on the insurers?
Just one thing relating to both of them. It's interesting with Aviva paring back that business model or rationalizing it. One of the benefits, apart from things like benefits to working capital this entails, is that it improves, or it should improve, the underwriting processes there as well. I mean, that's underwriting in a sense is a self-correcting mechanism, because a poor performance last year will feed into increased receipts in the next year. This seems to have happened with Admiral as well, because they did come a cropper because of the motor insurance market in the wake of the pandemic, and their underwriting activities didn't adequately reflect the increase in costs that we've seen through the industry. That wasn't necessarily their fault there, because there was major disruption to the market amongst many others at that period. But it's just worth keeping in mind, I think, whenever we look at the general insurers, that underwriting process is inbuilt into the system. So it's always best to look over a few years of performance for the insurers.
Indeed. Well, we do have a big feature actually coming up on insurance in print and online in a couple of weeks' time. So for those of you who want to find out more, want to work out whether the yields are attractive, and in some cases maybe work out what exactly is going on in these results, do look out for that feature. Now, though, we are turning to this week's cover feature, which, as mentioned at the top, is all about Alphabet, Google, etc., etc. Arthur is with us to discuss. We'll get to the big DOJ ruling in a moment, Arthur, but why don't we start just with a little bit of background, I suppose, to how Google got to its current position. We'll be going quite far back in order to do that, but let's set the scene a little bit and then get into current events, shall we?
Yeah, the feature sort of has a brief history of Google and how it ended up where it is, and that is important to the story now. And originally, when it was founded, just at the turn of the century, there were a few other search engines around, like most famously Yahoo, who were trying to sort of index the internet, I guess, because early on in the internet, there was just sort of these disparate websites, and it took a company to come along and sort of find them all, figure out where they were. And then the thing that Google did that helped it become dominant was it had this page rank algorithm that decided which website was most useful based on a set of criteria. So rather than, when you search something, rather than just getting everything in a random order, with Google, you would get the websites that the users thought were most interesting. And then that was sort of the beginning, and then there were lots of good strategic decisions as they went along. But as they then increased scale, they became more and more entrenched, because with these page rank algorithm, the more data it got, the better the page rank algorithm got, and the better the product was. On top of that, not only do you have to rank the pages, but you also have to understand what people are asking. And in the English language, certain words have different meanings in different contexts, for example. So the more data they got on the way that users queried their website, the better they got at answering their questions. And then this is sort of the basis for Google's monopoly, which is that the more traffic they got, the better their product got.
It's also led on to this antitrust case itself, hasn't it? Which focuses on the payments it makes to Apple in particular.
Yeah, exactly. So the more data it got, the better the product got. And Google obviously knew this and wanted as much traffic as it could get. And originally it was on PCs, because that's what everyone used in the early noughties to access the internet. But when smartphones, with the release of the iPhone in 2007, because the iPhone was basically an instant hit, I think, when Steve Jobs, I'm trying to remember, I was 13, I think, at the time. But I remember when it came out, everyone was really excited. It was like one of the few tech products, I think, which when it got released, everyone instantly knew it was going to be a massive hit.
Yep.
And Apple already had a deal with Google at that point, but then Google wanted then exclusive access to all of the search traffic that was going to come from smartphones, which today in the US is around 60% of all the search traffic comes from smartphones. So Google then signed this agreement with Apple, where they would pay Apple to be the primary search engine on Apple products, and then they then get all of the traffic that is coming through Apple products, including the iPhone, which was one of the main issues the Department of Justice had with Google in this recent case.
And we'll get. I'm delaying it still further, the discussion of the implications of that ruling. But before that, we should talk about the other context that's arisen in the last couple of years, which is, of course, artificial intelligence, and how that could be, on one level, an opportunity for Google, on one level also a threat, because there is this idea that if you use artificial intelligence, a chatbot, something like that, you may not need search anymore or as much. So how do you see that balance? What are the threats and opportunities for Google? What's it doing? And also, is there this sense that the launch of ChatGPT 18 months ago now, a bit longer, did in some ways come a bit quickly for Google? It made it speed up its plans and maybe made it respond in a way that it would have preferred to have had a bit more time to do.
Yeah, what it felt like, so it was right at the end of December 2022 when ChatGPT came out. And I guess similar to the iPhone, that was another product where everyone was immediately insanely excited about it, and its user growth was way faster than like TikTok and Instagram and other consumer products. And initially, people realized it was an amazing product, but didn't really know what the implications of it were going to be, and jumped on the fact that it was going to disrupt search because people would go into chatbots and ask it questions and it would give it answers, which is similar to what Google service was providing. The phrase that got thrown around at that point a bunch was like innovator's dilemma, which was that Google had over 90% of the search market and it was very profitable for it. So although it had been doing loads of AI research, and I don't know if you remember, but the summer of 2022, one of its engineers at Google got fired for saying that its chatbot at Google was sentient, and that was 6 months before ChatGPT got released. So everyone knew Google had the technology, but they just didn't release it because there wasn't that much upside to them profitability-wise to do that. And then OpenAI, which is backed by Microsoft, released ChatGPT in December because they didn't really have anything to lose. Bing is only 3% of the market. I don't know how the structure works, but I guess OpenAI could have made that decision even maybe without Microsoft, even if I'm sure Microsoft would have been supportive of it because Bing has so little to lose in terms of market share. And initially, Google's share price went down a bunch at the start of 2023. So broker estimates history, which looks at like for 2025 earnings. So that shows over time what the brokers think 2025 earnings is going to be. That troughed in March 2023, so 4 months after ChatGPT was released, but has been rising steadily since and is up 18% since then. I'm not entirely sure how much that would have been driven by the ChatGPT release, but the timing does line up pretty well. And that seems a little odd to me, just because AI is a threat to Google, but it is a threat and it will definitely change the business, but over a 10-year period rather than by 2025. So I think maybe there was an initial overreaction to the short-term earnings impact from the technology, but maybe judging by the analysts, what they've been saying about the company, there might be a long-term underreaction to what the technology will do and quite how much it's going to change its business. Because ultimately, 5 years ago or 4 years ago, whatever, you 100% knew Google was going to have a monopoly of the search engine market. There was no way that anyone in the current state of play was going to be able to dislodge it. And now everything's sort of up in the air. Microsoft and Google are basically in straight competition with each other. And it's obviously Amazon also has loads of computing power in terms of AI infrastructure, but all of it's up in the air now to who is going to be the winner. And I still think for multiple reasons, Google has a structural advantage. But the Department of Justice ruling does make a difference to this. We can get onto it now if you want to get into the implications then.
Yeah, let's talk about that because the judge will now decide on what's going to happen, having found Google to be a monopolist. The Department of Justice has effectively won the antitrust case, albeit Google is going to appeal, and we can expect some delays in that regard. What do we think the implications could be? At the very least, it seems quite likely, assuming the appeal doesn't work, that Google will have to stop making these payments to Apple to be the default search engine on the iPhone, et cetera, et cetera. But what do we sense could be some of the scenarios? Because there have been some more extreme scenarios posited this week as well.
There was an article in Bloomberg in the last few days that said that the most extreme thing being discussed was a full breakup of the company. But then what I'd read around that from analysts was that actually currently Google trading at 19 times its forward earnings, which is a lot cheaper than the rest of the big tech companies, is actually being undervalued, and as a sum of its parts is being undervalued. So if it had to split itself up and sell itself off if it had to split itself up as individual parts, the company would actually be valued more than it is in the whole. So that didn't seem to be a huge concern. And on top of that, it's maybe not the most likely scenario. The scenario that I think is more concerning and should be more concerning to shareholders, because it's more likely and also I think would be pretty damaging to its long-term earnings, is there are two options being discussed, which is that Google would have to share all of its data with other competitors, which is at the moment is its biggest trench and its biggest advantage going into this AI race, is because Google, there was a bit, the DOJ ruling has loads of interesting stuff around the way that business is run. And there's a bit in there saying it has over 15 times more data than any other of its competitors because of its monopoly position. And that gives it a large advantage in terms of training these models and the quality of its models. And I think it has now and will quickly exceed. It kind of comes down to marketing now. Like there's no discernible difference between what OpenAI is doing and what Google is doing in terms of the quality of its models, but all of the data it has should advantage it in the long run. And it will continue to get all of this data. We didn't mention it earlier, but Google's search business was like 13% year on year last earnings. And it still has over 90% of the market share. So although ChatGPT exists, people are still going to Google and using its search engine. So it still has the monopoly and it hasn't been impacted yet. So it's still gaining more and more data and can use it to train its models. But if it then has to share all of that or license, there's another thing, which is it could be forced to license it out for a payment, but that won't offset, I think, the moat that it gives up. So Bing, for example, is the only other company in the world that, maybe some Chinese ones, but that has an index of the whole internet in the same way that Google does. But because Bing doesn't make any money from its search engine, it licenses out the data to other search engines like DuckDuckGo. So it might be a similar situation where Google's forced to license out all of this stuff to external businesses. The other thing being mentioned was Google sends these web crawlers to all these websites constantly because if you change your website, Google wants to know, so it can maybe change the ranking or where it comes up in the algorithm. So it's constantly crawling the internet. Companies can block the crawlers. So earlier last year, I think the New York Times blocked OpenAI's crawlers because they didn't want OpenAI taking its articles for ChatGPT. But companies want Google's web crawlers to come on their websites because they want their websites to come up high up in the search engine. And there's a concern that Google would leverage that position to force companies to share its data, or then it would just use that data that it collects for its search engine to then use for AI. So it does have a lot of leverage over businesses in terms of collecting their data, because businesses still want to be highly ranked on the search engine, but then Google can then use it to train their models. So the Department of Justice is also thinking of cracking down on that practice. I don't know how it would work in practice, but that is one of their considerations to stop them leveraging that position, which would all be long term. I think RBC's note said that there should be there would be a valuation contraction, and this would create headwinds, which I do agree with.
Yeah, there are two sides to it, aren't there? Really, the worst case scenario from Alphabet's perspective would certainly be a breakup of Google, which the DOJ is reportedly going to push for when the judge eventually rules. That brings to mind their attempt to break up Microsoft in the 90s, which didn't happen. They weren't successful with that. The shares did fall, I think, when I last looked yesterday, they were down about 4% on this report. So some concern there. But perhaps the more likely scenarios are the ones you've just described, where the payments are stopping, some of the other practices which it currently engages in are going to be prohibited as well. The sense is that because Google does have 90% of the search market, desktop and mobile over 90%, that while it may lose a few percentage points from these things, it's not going to damage its overall dominance. The bigger concern might be, as you say, that it uses a lot of this data to train its AI models, and what the question will be, will that affect the amount of data or the quality of the data it gets? Probably not, because it's still going to have that large amount of existing data on there. But that probably brings us on to the AI side of things again, because I mean, there is this question for me, isn't there? Two things, really. One is that will AI make its search worse in two ways. One, by making it a worse user experience if the AI isn't working very well, as happened with Gemini, Google's system. There were these high-profile reports, weren't there, a few months ago of it recommending people eat rocks, etc. And okay, you can say they're teething problems, but there's also the issue of what it means for Google's advertising business if it rolls out what it started to do and put the AI results at the top. Will advertisers want to pay as much to get their search results higher up the list if they're still going to be behind AI? We don't know. And the other side of things is, I think it is a fair question to ask whether Google search has just got worse over the years in general anywhere. I feel like maybe it has. Maybe it's much harder nowadays to find something on there than it used to be. The point you make in the piece is quite interesting about its reputation was built on its reliability, its ability to find what you want, and maybe some of these things are calling it into question. So to me, there are some concerns about what the overall use of AI might do to its business, even though it's undoubtedly going to be an opportunity if it can get certainly a lot of enterprise use of AI. Is that a fair summary? Do you disagree maybe with some of those assumptions in there?
No, I think I agree with most of what you said. I think the point about which I'm eating rocks and stuff, I probably do think those are probably teething problems and make good screenshots on Twitter. But the point about advertising, I think, is important, which is that they have a way search has been built in a way which, to a degree, people have said has degraded the quality of the search engine already because it's so maximized towards advertising. So you're getting these like paid ad links coming up at the top and stuff, and people have already complained about that in terms of the search engine. But the way I don't think you guys get it. I'm in the US, so we have the AI over here. I don't think it's arrived in the UK yet, but it always comes up at the top of my search whenever I search for anything, and it is pretty useful. But sometimes if you're like fact checking something, or you just want you might just look at the top and then not scroll down at all. And they're sort of figuring out how they can monetize that. And also, if it's sort of just a chat, it's like a chat bot, so there's no individual link. So companies will pay to have their links moved up to the top, but they're sort of trying to figure out just so the chatbot style doesn't really lend itself to advertising in the same way that search does. And like OpenAI's ChatGPT is just a subscription page, which there's no advertising on it. They've gone down the subscription model route. And then Google does have Gemini, which is its sort of competitor to ChatGPT, which is also a subscription. And actually just recently, I think it was like 2 days ago, they had a presentation with their newest AI software. And you mentioned enterprise software. So that's an area where it's the opposite. Microsoft has basically the monopoly in enterprise software with Excel and Word and Office 365, and Google is the competitor. So Google will be hoping that Microsoft suffers the sort of same dilemma it has in search, and if it can use AI to disrupt Microsoft's position. And there was a product which I thought looked kind of cool that was released, which is it's like a research assistant. So you would go and you would be asked it a question, the AI, and then the AI, rather than just spewing out an answer, it would come back with like a research plan and what sources it was planning to go to, and then you can sign off on the research plan, and then it would go to all the websites and then put it straight into Google Docs so you can use it. So that seems like a more kind of like having an intern or something could work, but a bit more like tailored. So I think it could help Google Enterprise. The bigger issue in AI is the cost, though, which is these CapEx figures. In its last earnings, CapEx was like $1 billion ahead of earnings expectations. And it just is way more expensive to do an AI query than it is to do a search query. So if everyone's going to the website and doing AI searches, that's going to have higher cost of sales and bring down gross margin versus traditional search. And the point that feels a bit unfair on Google is that out of all the big tech companies, its business is by far the most expensive to run. Like its margins are high 20, operating margins still really good, but like high 20s or low 30s. Whereas Meta's way higher, Microsoft's way higher, because their businesses don't require, like these internet infrastructure businesses are so expensive to run, and they'll become even more expensive if all of them are being run through these AI models. But with like a social media platform, it's way cheaper because you don't have to worry about searching and indexing the whole internet constantly. Meta just has a bunch of users on Facebook and then has their data and monitors them and has to host all of those services, but it's way cheaper. So the concern with Google is that the moat has kind of kept it profitable, even though it has all of these costs, because it can charge so much for advertising and has such a good service. But as soon as the moat starts being sort of nibbled away at the edges by these regulators, its margin just starts coming down. And just because you're a monopoly doesn't mean it's gonna be good for shareholders, especially if it's a super expensive monopoly to run and requires loads of capex constantly. For example, BT and Vodafone, like they're still being regulated as monopolies, but their multiples are pathetic, and their share prices have been coming down for years. So I don't think that would be the worst case scenario. I think is the Google sort of becomes the telecom companies, because those telecoms companies used to be crazily have really high valuations and have never really recovered from the .com bubble. So I think that would be the worst case scenario for Google. Best case, it uses all its data. It is one of the two dominant AI companies, disrupts Microsoft in enterprise software and continues to, and the market grows so much that even if it has to share its pie with someone, it's still making way more earnings today than it used to. And at 19 times forward earnings, it is way cheaper than Microsoft, which is at 30 times. So actually out of the two, based on the earnings, I would probably choose Google, having said all of that, because it is way cheaper.
Yeah, I mean, there is a lot of that uncertainty in there, isn't there? That said, as you point out, the valuation is relatively attractive. The actual operating figures, which we haven't really had time to go into in detail, have been pretty good. We'll see how that comes out in the wash. The AI overview is interesting. I couldn't see any suggestion that it's actually officially been rolled out over here, but we do get it as well. I think if you put a question in to Google, you will see that AI overview come up at the top. So that's up to listeners to go and have a play around with that and see if they find it helpful or a hindrance. But there's a lot more detail in the cover feature. Got to move on now, though, to our final section, which is on OSB, Jemma, One Savings Bank. It's been another tough day for the company, as it was last time it reported, or certainly 6 months ago, 5 months ago now. What was in the figures that went down badly today?
Well, people weren't happy, Dan. People weren't happy. So for a bit of context, OSB is a lender that specialises in mortgages, and it has a particular focus on the buy-to-let market. So it gave a figure today saying roughly about a tenth of the new buy-to-let mortgages that were issued in May were done by itself. So in a way, there are a lot of attractions to this market, but I think at the moment, demand for mortgages is pretty subdued. And at the same time, competition between the lenders is heating up. And it's been quite a nasty combination of factors for OSB. So its loan book is growing more slowly than people were hoping, both in this half and sort of for the full year. So it downgraded its expectations for the full year. And its net interest margin is also under pressure. So between January and June, that came in below expectations. And again, it's downgraded the outlook for the full year. So those two things really caused shares to fall by almost a fifth in the immediate aftermath of the results. And I think they might have picked up ever so slightly since then, but still quite a nasty shock for the market, it seems.
We speak about, obviously, in the magazine and online, a lot of the pressures facing buy-to-let landlords as well. So this is a market, certainly for the small landlords, which is under pressure too, and with greater competition fighting for, if not a declining pie, then certainly a relatively stable pie. That is a tricky place to be. Another thing that has caught them out in recent months, there was a little bit in the results again today, was the remortgaging time, the amount of time that landlords spend on the standard variable rate between coming off one mortgage and going on to a new deal. Why don't we set the scene first of all, what happened in March and what we're seeing today, what they've said about that today?
Yeah, so the bank seems to be repeatedly caught out by this. So basically, it's the buy-to-let landlords are very quick off the mark to refinance their loans because they're thinking, oh my goodness, we want to get the best deal. They don't want to sit on the reversion rate that kicks in once a fixed rate mortgage ends for very long. So they're either going to a competitor or refinancing with OSB, and that's impacting the net interest margin. So it's a continuation of an existing story. So as you mentioned, last summer, OSB put out quite a depressing trading update saying it was going to have to put in place this big adjustment to its effective interest rate because of these pressures, this quick off the mark nature of their customers. And at the time, that caused shares to fall very steeply. And essentially, we've had a repeat of that today because, as you say, they didn't give a huge amount of detail, but they said, customers in the buy-to-let market were still acting very fast and still seeming very unwilling to sit on those reversion rates.
Yeah, you're right. There was last summer is when they first came out with it, a little bit of repetition in the full year results too. They didn't have to make the big adjustment this time, but there is a warning in there as well. It seems to me, at least, in the results today, isn't there? As regards what they've seen in recent weeks, again regarding landlord behaviour.
Yes, so they basically said, we've seen this behaviour again, but we're not thinking that it's a trend. So they're not actively going to change the assumptions they make around customer behaviour because they think maybe it's not going to be a prolonged thing. I wonder, given what we've seen over the last year or so, whether shareholders will be completely convinced by that. So I was looking at a report by Peel Hunt today, which was, relatively optimistic, but then it was saying net interest margin trends into 2025 are unclear, but based on the rebase level for 2024, we're thinking they're going to be below previous expectations. So there definitely seems to be a level of scepticism. But OSB's mentality was, borrowers' behaviours can be variable as base rate and market dynamics change. We've seen one interest rate cut now, so maybe people will start acting a bit differently.
Maybe they'll, relax a little more, but the fact is rates are still at 5%. Yes, I suppose in their defence, the adjustment, each time they make an adjustment, it does mean they are narrowing the amount of time they think borrowers will be spending on the variable rate. I'm not sure. I don't have the figures with me, but I think it might be around 5 months or something like that at the moment is the expectation, maybe a bit lower. I have seen some analysts suggest that amount of time, it does sound like a long time to be on a variable rate, so maybe that's completely wrong to be fair. But analysts suggest that will continue to contract, which does mean, if they're right, that this behaviour seen in the second quarter would be a new trend. So we'll see what happens there. The point about the net interest margin, though, we should maybe wrap up on that, because this is something which presumably is going to start affecting all banks from next reporting period onwards. Now that base rates are starting to fall, the amount they can make on the margin is going to start falling. Julian, maybe to wrap up, we can get your thoughts on that, because clearly banks have enjoyed a good couple of years and a longer period than people thought when it comes to high interest margins, because interest rates have stayed higher for longer. But could we start to see some of that ebb away? Clearly, I think it's something we should be expecting, but would we expect a bad market reaction when people start narrowing interest margin forecasts, say, in the third quarter? What do you think?
Essentially, the banks have been earning free money at a certain percentage. I don't think they should worry too much about it, to be honest. There are two things to consider. I mean, firstly, it's given them a vast pot of money that they can give away. So share buybacks and dividends have supported the shares over the last, certainly since the start of the year. And they've still got the firepower to continue that into next year. The other point is that the bigger the bank, the more flexibility they have in terms of defending the balance sheet. So they have the option of expanding the balance sheet by writing more loans and mortgages if there's demand. And that offsets, to a certain extent, any contraction in the net interest margin. And they also have the option of hedging any fall in interest rates, which is something that banks like HSBC have been doing quite heavily over the last year or so. I mean, they're more insulated. The problem is with these smaller players, more focused and specialized banking entities, that they don't have that level of flexibility, particularly if they're focused on one market like buy-to-let, which is why OSB has been suffering in particular. But it might apply to other banks in the sector like Paragon other smaller players.
Yeah.
They're just too small, really, to benefit from the economies of scale that you get with the likes of NatWest or HSBC.
Indeed. It's a good point that demand should pick up, being the flip side, of course, of a falling rates, but we'll see. We have, though, reached the end of today's show. We've run out of time. Thank you very much to Julian, to Jemma, to Arthur, to Mark, to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.